How can students with little to no money actually build serious wealth before graduation? I get it. I was once in your shoes, juggling tuition, part-time jobs, and wondering if financial freedom was even possible. In today's video, I'm breaking down the student's guide to building $1 million portfolio before graduation. You'll learn the exact strategies, mindset shifts, and investment steps that can turn pocket change into real wealth before you even walk across that stage. Many students dream of financial freedom, but their mindset is often the biggest barrier. The problem begins with a belief that wealth is something only possible after years of working a stable career, climbing the corporate ladder, or inheriting money. This mentality keeps students stuck in a cycle of living paycheck to paycheck, focusing only on short-term needs like tuition, rent, and daily expenses. They see investing or building a portfolio as something for later, a dream too far away. This delay in action means they lose the crucial advantage of time, which is the biggest asset in wealth building. Without the right mindset, even the best opportunities will pass unnoticed, and financial freedom will remain a distant goal rather than a tangible reality. The key problem is that most students don't realize that building wealth isn't just about how much money you have today. It's about the mindset and habits you develop now. The solution begins with adopting a millionaire mindset early, thinking like an investor rather than a consumer. This shift changes the way students approach money, turning even small earnings into powerful tools for building long-term wealth. It starts with understanding that every dollar saved and invested today has the potential to grow exponentially by the time they graduate. This requires adopting the habit of asking, how can I make this money work for me? Instead of, how can I spend this money? A key part of this mindset is embracing patience and discipline. Wealth rarely comes overnight, but with consistent effort and smart strategies, it can accumulate far faster than most students realize. The next step is education. Students need to learn about investing, compound interest, and portfolio diversification. This doesn't mean becoming an expert overnight, but taking the time to understand the basics of stocks, ETFs, real estate, and other asset classes. Knowledge itself becomes a form of capital, empowering students to make informed decisions rather than relying on guesswork. Building this knowledge early gives students a huge advantage, allowing them to spot opportunities that others overlook. This mindset shift transforms how they view money as a tool to build wealth, not just a resource to spend. An example of this mindset shift comes from a student named Alex, who started university with very little savings but a clear plan. Alex worked part-time, lived frugally, and committed to learning about investing. Instead of spending extra income on unnecessary luxuries, Alex invested small amounts regularly into a diversified portfolio of ETFs and dividend stocks. Over time, Alex's portfolio began to grow, not just through contributions, but also through compound interest. By graduation, Alex had a portfolio worth tens of thousands of dollars, an achievement that seemed impossible at the start. This was not the result of luck, but a deliberate shift in thinking. Alex adopted a long-term mindset, seeing every small contribution as a building block toward a much larger goal. Another important aspect is surrounding yourself with the right influences. Many students fall into limiting beliefs because they are surrounded by peers who see money only as something to spend. To truly change your mindset, it's essential to engage with people, communities, and resources that inspire financial growth. This could mean joining student investment clubs, following financial educators online, or even discussing money goals with mentors. The environment shapes the way you think about money, and shifting your surroundings can dramatically accelerate your progress. This mindset shift also includes redefining success. For many students, success is measured by grades, degrees, or immediate income. But building a millionaire portfolio before graduation requires redefining success as consistent progress, smart investing, and long-term growth. It's about value in the process over quick wins and understanding that small, consistent actions compound into extraordinary results over time. One of the biggest challenges students face when trying to build wealth before graduation is managing limited income. Many students depend on part-time jobs, scholarships, or allowances that barely cover tuition, rent, and daily expenses. This creates a problem where there is little to no money left to save or invest, which makes building a portfolio seem impossible. The issue is compounded by lifestyle pressures, the desire to socialize, buy the latest gadgets, or maintain appearances among peers. Without a strategy, students often end up spending everything they earn, and the idea of creating wealth before graduation remains a dream rather than a reality. The real problem lies in the lack of financial discipline and a clear budgeting system that aligns with long-term goals. The solution to this problem is smart budgeting, a system that prioritizes investments and savings before discretionary spending. Instead of thinking about budgeting as restricting yourself, it should be seen as a tool for building freedom. A smart budget allows a student to allocate income toward essential expenses, savings, and investments in a structured way. This approach flips the mindset from how much money do I have left after spending to how much can I allocate toward growth. One powerful method is the 50-30-20 budgeting rule, but adapted for aggressive wealth building. For students, this might mean allocating 50% of income to essentials, 20% to savings and investments, and 30% to lifestyle. But the percentages can be adjusted depending on income level and goals. The key is consistency. Another important part of smart budgeting is tracking expenses. Many students lose track of how their money is spent, which makes it impossible to know where they can cut back. Using budgeting apps or simple spreadsheets can provide clarity. This not only helps in identifying wasteful spending, but also reveals opportunities to redirect funds toward investments. The habit of tracking expenses builds discipline and creates a financial awareness that is essential for portfolio growth. An example of effective budgeting comes from a student named Mia, who was determined to graduate with a strong investment portfolio. Maya worked part-time while studying and decided to follow a strict budgeting system. She allocated a fixed percentage of her monthly income toward investments before paying for discretionary spending. Even though her monthly contributions were small at first, this discipline compounded over time. Mia chose low-cost index funds and dividend stocks, and within 2 years, she had accumulated a portfolio worth a substantial amount, a foundation that would grow significantly by graduation. Her success wasn't about earning huge sums, but about creating a budgeting system that ensured every dollar had a purpose and contributed toward her long-term goal. Smart budgeting also involves being intentional about lifestyle choices. Students often fall into the trap of thinking wealth is built through high income alone, but lifestyle inflation can quickly erode any financial gains. The solution is to develop conscious spending habits that align with your investment goals. This might mean cooking at home instead of eating out, finding affordable housing, or leveraging student discounts. Small sacrifices can lead to big gains when redirected toward investments. Another example comes from a group of friends who started a budget challenge in their second year of college. They committed to tracking all expenses, cutting unnecessary costs, and pooling savings to invest together. This collective accountability not only kept them disciplined, but also turned budgeting into a shared growth experience. Their portfolios grew faster than they imagined, and they developed a habit of living below their means without sacrificing quality of life. Budgeting isn't just about cutting costs. It's about making money work for you in the smartest way possible. For students, it means turning limited income into a powerful tool for growth. The challenge is not in earning money alone, but in having the discipline to allocate it toward building something bigger than just covering day-to-day expenses. Smart budgeting transforms money from a fleeting resource into a powerful foundation for building $1 million portfolio before graduation. A major challenge students face when trying to build a portfolio before graduation is knowing where to invest. Many students are aware of the importance of investing, but the problem lies in identifying assets that deliver high growth without exposing them to excessive risk. Without proper guidance, students often fall into common traps, such as investing in high-risk ventures without adequate research or putting all their money into low-yield savings accounts. The result is slow growth or even losses, which can discourage them from continuing to invest. Another issue is a lack of knowledge about how compound growth works, which leads to undervaluing the potential of starting early. The underlying problem is that students often approach investing without a clear strategy, turning it into a gamble rather than a disciplined wealth building process. The solution is focusing on high-growth investments while balancing risk. This requires understanding different types of assets and how they fit into a portfolio designed for long-term growth. Students should begin with a foundation of low-cost index funds and exchange-traded funds, ETFs, which track major market indexes and offer steady growth over time. These are generally less risky and provide broad market exposure, making them ideal for beginners. Once they understand the basics, students can diversify by including individual stocks in high-growth sectors such as technology, renewable energy, or healthcare, which have the potential to deliver outsized returns over time. Another powerful approach is investing in dividend-paying stocks, which provide both capital appreciation and passive income that can be reinvested. A key strategy is dollar cost averaging, investing a fixed amount regularly, regardless of market conditions. This strategy removes the stress of timing the market and allows students to benefit from long-term compounding. Consistent contributions, even if small, can grow exponentially over time due to compound interest. An example comes from a student named Jason who started investing during his first year of college with only $50 a month. Jason didn't aim for short-term wins. Instead, he focused on high-quality ETFs and a few well-researched growth stocks. He used dollar cost averaging to steadily build his portfolio, and because he started early, the power of compounding worked in his favor. By the time he reached his third year, his portfolio had grown significantly, not just from his contributions, but from returns on investment. Jason's success demonstrates that it's not about how much you start with. It's about starting early, being consistent, and choosing investments wisely. Another important aspect of high-growth investing is continuous learning. Students must develop the habit of studying the market, understanding trends, and adjusting their portfolio accordingly. This can be done by following credible financial news, joining student investment groups, or using investment simulators to test strategies without risk. Building this knowledge early not only improves investment decisions, but also creates confidence in the process. An additional example comes from Sarah, who combined her part-time income with a disciplined investment strategy. She allocated a portion of her earnings each month to a mix of index funds and individual stocks in emerging industries. Sarah also reinvested dividends, allowing her portfolio to grow faster. By graduation, she had not only a strong portfolio, but also a deep understanding of investing principles, an asset far more valuable than money alone. High-growth investing requires a combination of strategy, discipline, and patience. It's not about chasing every trendy stock, but about building a portfolio that grows steadily over time while taking advantage of compounding. For students, this means starting early, allocating a fixed portion of income toward investments, diversifying across growth assets, and continually educating themselves. This approach transforms investing from a vague ambition into a concrete path toward building $1 million portfolio before graduation. One of the biggest problems students face when building wealth before graduation is the misconception that earning money must come from active work alone. Most students believe the only way to make more money is to work more hours, taking extra shifts, tutoring, freelancing. But this approach has limits. Time is finite, and relying solely on active income means trading hours for dollars, which caps potential earnings. This problem is compounded by the fact that student schedules are already packed with classes, assignments, and exams. The result is burnout, limited earning potential, and no real system for building long-term wealth. Students often miss the fact that the real power of wealth building lies in generating income streams that work without constant effort. Passive income streams. Without passive income, even a good investment strategy might take much longer to grow into $1 million portfolio. The solution is creating multiple passive income streams that generate revenue without continuous active effort. Passive income allows students to earn while focusing on studies or other growth opportunities. The key is identifying realistic passive income streams that fit into a student's lifestyle and financial capacity. This can include dividend-paying stocks, which distribute a portion of a company's profits to shareholders, rental income from real estate investments, peer-to-peer lending, creating digital products, or building online content that generates ad revenue. The goal is to establish income sources that grow over time without requiring constant input, freeing up energy and time to reinvest in both studies and portfolios. The first step in creating passive income is understanding which options align with your skill set, resources, and timeline. Dividend investing is often the simplest for students, as it requires a one-time purchase of stocks and minimal ongoing work. Many companies pay dividends quarterly, meaning students can start generating a small but consistent income that grows as they reinvest those dividends. Another option is creating digital content, such as blogs, YouTube channels, or online courses which can produce revenue long after the initial work is done. Even small projects can compound into significant income streams over time. An example of successful passive income building is a student named Kevin, who began his college journey with no savings but a laptop and an interest in content creation. Kevin started a YouTube channel focused on student finance tips and monetized it through ads and sponsorships. While his channel grew slowly at first, he treated it as an investment, putting in the work early without expecting instant results. Over 2 years, Kevin's channel began earning enough to not only cover his expenses, but also fund his investments. He reinvested this income into dividend-paying stocks and ETFs, creating a powerful cycle of passive growth that accelerated his portfolio building. Another example comes from Emma, who was interested in real estate but couldn't afford a property outright as a student. She explored REITs, real estate investment trusts, which allowed her to invest in real estate markets without large upfront costs. Emma allocated a portion of her budget to REITs, which provided her with regular dividend income. She combined this with a small freelancing side hustle to cover living expenses, allowing her to reinvest dividends and steadily grow her portfolio. By the time she graduated, Emma had built a diversified income stream that required little ongoing effort to maintain. Creating passive income as a student requires patience, experimentation, and strategic allocation of resources. It often begins with small investments or projects, but the compounding effect can transform them into powerful financial engines over time. Students need to approach passive income not as a get-rich-quick scheme, but as a long-term strategy that builds steadily. The discipline to start early, the creativity to identify opportunities, and the persistence to maintain and grow these income streams can turn a student's limited time and resources into a sustainable foundation for wealth. A major challenge for students who want to build wealth before graduation is managing risk. Many students are eager to invest, but are either overly cautious or overly aggressive. Overly cautious students avoid investing because they fear losing money, sticking their savings in low-yield accounts that barely keep pace with inflation. Overly aggressive students, on the other hand, chase high-risk investments without proper research, hoping for quick gains, only to face significant losses. Both extremes hinder wealth building because they either limit growth or expose portfolios to unnecessary danger. The core problem is a lack of understanding about how to balance risk and reward. especially in the context of limited capital and short timelines. Without effective risk management, even the best strategies can fail and students can end up losing both money and motivation. The solution lies in adopting a strategic approach to risk management, which balances growth opportunities with protection against losses. This means building a diversified portfolio, conducting proper research, and investing according to a clear plan that matches both financial goals and risk tolerance. Diversification is one of the most powerful tools for managing risk. By spreading investments across different asset classes, such as stocks, ETFs, bonds, and real estate, students reduce the potential impact of any single investment underperforming. This doesn't eliminate risk entirely, but makes it much more manageable while preserving growth potential. Another risk management strategy is setting clear investment goals. Students should define their target portfolio size, the level of risk they are comfortable with, and their investment timeline. This clarity allows them to choose the right assets and avoid impulsive decisions driven by emotions or hype. Another important practice is starting small and gradually increasing investment amounts as confidence and experience grow. This approach allows students to learn without risking too much capital early on. An example comes from a student named Liam, who wanted to build a significant portfolio before graduation, but was cautious about taking unnecessary risks. Liam allocated his investments across different assets: 60% in low-cost index funds, 20% in dividend stocks, 10% in a small real estate investment via REITs, and 10% in a higher risk-tech startup stock he believed in after thorough research. This diversified approach protected his portfolio from volatility while allowing for steady growth. Even when the market dipped, the majority of Liam's investments remained stable and his portfolio continued growing overall. Another example is Sophia, who adopted a risk management strategy by combining investing with education. She set aside time each week to learn about portfolio balancing, reading market reports, and analyzing her asset performance. Sophia used a simulated investment app to practice without real risk, which helped her refine her strategy. By the time she started investing with real money, she had a clear plan and confidence in her choices. She began with a mix of ETFs for stability and small positions in emerging sectors for growth, gradually increasing her exposure to higher risk assets as her knowledge improved. This allowed her to manage risk effectively while maximizing her growth potential. Risk management also involves maintaining flexibility. Markets change, and what works one year may not work the next. Students should review their portfolios regularly and adjust allocations based on performance, market conditions, and personal circumstances. This proactive approach prevents portfolios from becoming stagnant or overly exposed to risk. Risk management isn't about avoiding risk entirely, but making informed decisions that balance potential gains with acceptable losses. For students, effective risk management is about discipline, education, and strategic planning. It's about building a portfolio that can withstand volatility while still growing steadily. This requires commitment to learning, consistent monitoring, and the willingness to adjust strategies as needed. By adopting a balanced approach to risk, students can protect their investments and accelerate the journey toward building $1 million portfolio before graduation. A critical problem students face when aiming to build $1 million portfolio before graduation is scaling their investments effectively. Many students start investing with small amounts but stop short of finding ways to grow their portfolio at an accelerated rate. The challenge comes from a combination of limited income, lack of clear scaling strategies, and uncertainty about how to reinvest gains. Without scaling, even disciplined investing and budgeting will produce slower results, and the gap between current savings and the $1 million goal will remain too wide. The issue is not just earning money, but knowing how to strategically reinvest and expand the portfolio to maximize returns within the limited time before graduation. The solution is to implement a portfolio scaling strategy that allows consistent growth while leveraging both income and returns. This means reinvesting gains, increasing investment contributions over time, and diversifying into higher return opportunities while keeping risk under control. Scaling starts with maximizing the efficiency of current investments. Dividend reinvestment, for example, allows a portfolio to grow exponentially without additional input. Students should also look to increase contributions when possible, whether through part-time work, side hustles, or relocating discretionary spending toward investments. This creates a compounding effect where both contributions and returns grow together. Another key aspect of scaling is diversification into asset classes that offer higher growth potential over time. This might include growth stocks, real estate crowdfunding, cryptocurrencies, or other emerging markets. While these carry higher risks, they also offer opportunities for outsized returns, which can dramatically accelerate portfolio growth if approached strategically. It's important for students to scale gradually, starting with safer investments and slowly incorporating higher risk opportunities as their knowledge and capital increase. This balanced approach allows them to capture growth while managing potential losses. An example of effective scaling comes from a student named Daniel, who began investing in his first year of college with a modest budget. Daniel started with low-cost index funds and dividend stocks, contributing small amounts monthly. As he gained experience and confidence, he began scaling by adding higher growth investments, including a small position in a tech ETF and a cryptocurrency fund. He also reinvested all dividends and returns back into his portfolio. Over the years, Daniel increased his monthly contributions as he earned more from part-time work and side projects. This compounding strategy allowed his portfolio to grow at an accelerating pace, putting him far ahead of his peers by graduation. Another example comes from Leah, who combined scaling her portfolio with building multiple income streams. Leah began with a focus on dividend stocks, but soon added real estate crowdfunding investments to her portfolio. She also used profits from a small e-commerce business she ran to increase her monthly contributions to her investment accounts. By strategically reinvesting her profits and expanding into higher growth assets, Leah was able to scale her portfolio significantly in just a few years. Her strategy was not just about investing more money, but about making each dollar work harder through smart allocation and reinvestment. Portfolio scaling also requires regular review and adaptation. Students need to monitor their investments and adjust allocations to match changing market conditions and personal circumstances. This could mean shifting funds from slower growth assets to faster growing opportunities or diversifying further to spread risk. Scaling is not a one-time action, but a continuous process that evolves alongside the investor's knowledge and resources. For students, the challenge of scaling a portfolio is overcome by a mix of reinvesting returns, increasing contributions, and strategically diversifying into higher growth assets. This requires discipline, creativity, and a willingness to adapt. Scaling transforms small beginnings into significant wealth by turning every contribution and return into a stepping stone toward a larger goal. By understanding and applying these principles, students can turn a modest portfolio into $1 million portfolio before graduation. In this guide, we've uncovered the exact strategies students need to build $1 million portfolio before graduation. We started with a mindset shift, showing how thinking like an investor early can unlock long-term growth. Then we explored smart budgeting, turning limited income into powerful investment capital. We covered high growth investments and the importance of dollar cost averaging, teaching students how to maximize returns over time. Next, we examined passive income streams, revealing ways to earn while studying. Risk management showed how to protect gains while growing steadily. And portfolio scaling taught how to turn small contributions into massive wealth through reinvestment and diversification. Each step builds on the last, creating a complete roadmap for turning student years into the foundation of financial freedom. If you found value in this video, make sure to subscribe, like, and comment below your biggest takeaway. Your support fuels more content like this.